some doubts are creeping in, and I think that's where we are.
There is the potential that we continue to see kind of this re-rack in terms of asset allocation.
There's just a lot more momentum in the U.S. economy.
The Fed's still telling us we'll keep raising rates. Global growth is slowing. Risk aversion is pervasive. You're going to buy the dollar.
The issue for equities, I think, really is down to a hard landing or soft landing. If there's a hard landing, you definitely cannot be bullish on equities.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 9 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. Today's U.S. jobs report could determine what the Fed does next. A tight labour market has been pushing up wages and inflation, prompting the Fed to raise interest rates further. It's the new era of tech austerity. Lyft is making deep job cuts. Amazon puts some hiring on hold, and Twitter prepares for massive layoffs today. And the stock frenzy in China goes into overdrive. Investors are spurred on by market-friendly headlines and the hopes that the worst could be over. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller. Matt Miller actually off today. Kailey Leinz is with me. Chrissy Gupta, of course, also standing in for Matt Miller in New York. And Kailey, another day where here in Europe we're seeing the read across from actually what's happening in the Chinese markets and expectation, well-founded or otherwise, around a change in COVID policy pushing stocks higher.
Yeah, Chinese stocks were on fire overnight, Anna. They were roaring higher because, once again, hope seems to be prevalent that we will see an easing up in COVID zero policy after a report that China may be looking to ease penalties on airlines as it relates to COVID. Plus, you have the additional good news that U.S. audit inspectors are ahead of schedule in their on-site inspections of Chinese companies that are listed here in the U.S. So all of that together collectively giving a huge boost to risk appetite. The Hang Seng China Enterprise Index up 6% on the day, rounding it out its best week since 2015. And the Hang Seng Tech Index up 7.5%, had its best week in its existence. And of course, that optimism is filtering through to other asset classes as well. In foreign exchange, the Chinese yuan strengthening against the U.S. dollar to the 726.81 level. And in commodities, the idea that demand may be recovering in China has lifted iron ore for 4 days in a row, up 5.3% overnight. $86 a ton is where we trade crude. That is the longest winning streak for iron ore going back to July.
Well, certainly something that I think U.S. markets are probably taking their cue from futures to commodities. Take a look at the S&P 500 futures. They are up about 0.5%. But what's interesting to me is that, once again, it seems like more sentiment-driven than perhaps fundamentally driven. Anything can happen at 8:30 today with that jobs report. It can be a complete game changer, especially given that we've had about 4 days of losses. So to see that happen in a row, it's kind of natural to have a little bit of a technical bounce. But once again, the fundamentals can change everything. For the bond market, it's a little bit of a different story because you are seeing the 10-year yield hover around that 412 level. Right now, only down 1 basis point in the session. That is not the driver for the dollar, though, where you are seeing some very real weakness, down about 0.5%. But once again, similar to the stock market, perhaps the commodity market taking its cue from the Asia session that Kailey just laid out. You are seeing NYMEX crude hovering about 90 with a 2.4% gain, Anna.
Yeah, those moves higher in commodities, Chrissy, having an impact on the European session. We have European stocks moving higher broadly, quite bright green, in fact. The CAC 40 up by more than 1.2%, the FTSE 100 up by more than 1%. We've had some Euro area October services PMI data, so a snapshot of the health or otherwise of the services sector across the Eurozone. It's coming at 48.6. That's a little bit ahead of the prelim number of 48.2, but of course below 50, still in contraction territory. So sort of as you were in terms of knowing that the services sector is in retreat across the Eurozone. That's the data set we've had this morning. Let's have a look at some of the detail behind these moves. And basic resources, as you mentioned, Chrissy, a focus for markets today. Some of those prices are going higher of those underlying commodities, and so the stocks connected to those go higher here in London, up by 4.7% on that basic resources sector, and that is a big push higher for the London market. The UK 2-year yield, we put this in here. We see those yields actually coming down. We see some demand for the 2-year yield, and yes, those yields coming down just a touch. 3.03 is where we stand. We haven't seen all that much movement, and any movement we have seen at the short end has been in the direction that the Bank of England didn't want. So yesterday we heard from the Bank of England that they think the market is pricing in too many hikes. We saw the markets move in the opposite direction to that guidance yesterday, and today the movement hasn't been all that significant. And yesterday we heard from Bailey, today we heard from Hugh Pill, both reiterating they think that markets need to adjust downwards in terms of their expectations of how many hikes are still to come. We'll see if the market is in listening mode as the days pass. JC JCDecaux up 11.4%, a French advertising, outdoor advertising and other business. And just an example, really, of how it is still possible to be impressive with your results. And that's certainly what this company has done. The delivery of the numbers, the guidance, all going down well with analysts, and the stock has bounced this morning significantly. And Kering, another French name, this in the luxury space, up by 3.5%. Lots of reports suggesting that they could be doing some M&A, could be interested in buying Tom Ford. That has been taken well by investors, analysts saying this would be a good deal for the business, Kailey.
All right, Anna, well, let's get back to the big event of the day. The monthly U.S. jobs report is going to be out at 8:30 a.m. Eastern, and the question is whether the labor market is cooling enough for the Federal Reserve. Michael McKee, Bloomberg International Economics and Policy Correspondent, joins us now with more on what to expect from the data. Mike, what are we looking for?
Well, we're in this weird situation, Kailey, where this is not the most important jobs report of all time, as we like to usually promote it, but it could have a major impact on the markets, and that's because Kailey's right. The Fed is looking for a slowdown, and a slowdown is what's priced into the consensus forecast, 195,000 jobs created during the month of October, with the unemployment rate ticking up and wages ticking down. The problem is the whisper number on Wall Street is higher than the forecast number, and there is a fear that we could skew to the upside, which would lead the Fed to probably have to do more, and we're seeing that reflected in the futures that are right now pricing the Fed at 5.25% by next June. That's almost 50 basis points higher than we came into this week after the Fed's news conference, Jay Powell's news conference this week. Now, why did I say it's not the most important number of all time? That's because Fed doesn't meet again until December 14th. There's another payrolls report, and there are two CPI numbers and PCE price index number ahead of that Fed meeting. So any kind of reaction today could be rather strong, but it might be short-lived.
Well, one of the takeaways, and I would argue anomalies of yesterday's trading session, was it felt like the repricing that everyone was perhaps freaking out about on the back of Chairman Powell's comments on Wednesday wasn't as severe as perhaps a lot of people expected. Is the jobs number going to be that game changer, not just for the bond market, but for the swaps pricing?
Probably not a game changer for the reasons I laid out, in the sense that there's a lot more data to come and the markets will reprice in those situations. But it could give momentum to a view that the Fed has got to do more. One reason they probably didn't reprice as much as people thought yesterday is they had already front-run the Fed. Let's see what happens after today's number.
Mike, thanks very much. Bloomberg's Michael McKee with the latest on the labour market, what we can expect. And catch our interview with the US Labour Secretary, Marty Walsh. That's following the jobs report. That is at 9:30 a.m. New York time, 1:30 p.m. in London. Now let's move on to the tech sector. Tech companies are once again hitting the brakes on hiring as they deal with sluggish consumer spending, higher interest rates, and the impact of a strong dollar overseas. Bloomberg's Danny Berger joins us now with more. Danny, take us through where we're seeing some of these job losses coming through.
Yeah, if you want to see cracks in the labor market, this is precisely where. It's tech realizing that they need to get slimmer, thinner in a new economic reality that doesn't accept growth at all costs anymore. So you have two kind of models. You have the Amazons, the Apples, who are just freezing hiring, so that's job loss by attrition. And then you have, for example, Lyft, Opendoor, Stripe, Chime. They're actually laying off folks, you know, in the low teens worth percentage of their staff workforce. But this really, to some degree, is tech's own making. They were one of the few sectors to do well during COVID. They spent a lot more. Amazon bought more warehouses. They hired a lot. And all of a sudden, the economy has changed. So they led up on the way up. They're leading on the way down. Stripe's CEO put this really well in his memo to Workforce, just saying, we overhired for the current climate. We overestimated what the internet-led economy would look like this next year and underestimated the economic pain.
Yeah, so Kailey, the real world fought back, and this is the jobs picture that results.
Yeah, it's pretty brutal, and you've seen a string of these announcements at the same time, perhaps somewhat related to what's going on more broadly, but mostly related to the fact that he overpaid for Twitter with a $44 billion deal. Elon Musk is looking to cut costs, and as of today, he's going to start eliminating about 3,700 jobs at Twitter. Danny, what do we know?
Yeah, well, on your first point, you know, it's hard to imagine a reality where Twitter wouldn't have had to cut costs anyway, just because of what's happening to tech overall. But yes, Elon Musk did promise to cut costs. And we learned that he was looking at up to 50% of the workforce he would cut. But there is this act. It's called the WARN Act. I'm going to be honest, I do not remember what it stands for, but I do know what it means. It is basically says that large companies can't mount mass layoffs without at least 60 days of advance notice. So the thinking is that he's just letting go of too many people, again, without giving 2 months of notice. To be fair, Tesla, it has faced similar lawsuits when they tried to let go about 10% of their workforce. Our editor-in-chief, John Micklethwaite, talked to Elon Musk about this when he interviewed him at the Qatar Economic Forum, and Elon Musk described it as trivial, so it's unlikely, at least publicly, he'll express too much concern about this lawsuit.
Bloomberg's Danny Berger with all things job layoffs in the tech sector. We thank you as always. It's interesting. It's not even just the tech sector. You're starting to see it in the likes of Coca-Cola even offering buyouts to perhaps get some people to leave their workforce as well. From the U.S., let's go over to China, though, which once, of course, is affecting a lot of sentiment, working on plans to potentially scrap a system that penalizes airlines for bringing virus cases into the country. Chinese shares surging amid signs that authorities are trying harder to ease the impact of the COVID-0 policy. Bloomberg Markets editor Valerie Teitel joins us now for more. Valerie, what an explosion in Chinese equities. Is this an overreaction?
Yeah, it was a monster reaction to these. The first news that the more official line of speaking that this reopening might actually be happening. And there were so many superlatives overnight to choose from, but I've got two great ones. Hong Kong stocks, the HSI index, had its best week since 2011, now that they've closed the books for the year. And my second chart, my favorite one, this same index, if you look at it on a monthly basis, it's having its best month in 7 years, and it's only the 4th of November. It's just an incredible turnaround. You might call it an overreaction, but look, we're coming off the back of one of the worst 2 months for Chinese stocks in history. And look, a lot of that was led by Xi and his new government appointments that made us worry that China is stepping back from the world economy and they're going to further isolate themselves from global trade. But again, overnight, the Xi-Scholz meeting that we had, he's promising closer ties to Germany. He wants to strengthen the relationship. So that's clearly throwing cold water on what led the 2 months of decline previously. But look, you might say, yeah, Valerie, big deal. Monster rally in China. It doesn't really affect U.S. shares as much as it has in the past. But look, if we look at the commodity space, oil is continuing to react to these headlines. And I say this because we know the China reopening is going to be gradual. Perhaps it's a second half 2023 story. But that is the same time at which the market is pricing the Fed pausing its interest rate cycle. And look, China reopening, there's no doubt about it. It's going to cause an inflationary pressure through the commodity space. And that could happen, Kailey, just at the same time that the Fed is hoping to pause their interest rate hikes. It's going to be a very interesting dynamic to see if these two timelines play out in congruence.
Yeah, it's a really good point, Valerie. We've been living in a commodity-constrained world, and that was without even China online. So it'll be really interesting to see how that changes those dynamics. Bloomberg's Valerie Teitel, thank you so much. And as always, you can see her great charts at GTV Go on the Bloomberg terminal. But let's get back to some micro stories and take a look at some stocks moving in pre-market trading here in the U.S. We had a lot of earnings out after the bell yesterday, one of them being Square or Block. Formerly Square, I should say. It beat expectations on the top and bottom line, getting a boost from retailers and restaurants using its sales products. So as a result, it is up about 13.5% before the bell. You have other big upside movers as well, one of them being DoorDash. Apparently, inflation is not keeping all of us from not ordering takeout. We still want to do that. We still want food delivered to our homes. So it topped expectations. Its order value was up 30% in the third quarter. That stock up about 11%. And finally, Coinbase as well. This is an interesting one because it missed on revenue. The CFO was talking about a prolonged period of struggling because of the crypto downturn, but it also reported a narrower loss. And so as a result, Coinbase up about 8.2% before the bell, Anna.
Okay, DoorDash and Coinbase, that's a heady mix. Thanks, Kailey. Let's get to telling you what's coming up on the programme. Stephen Englander joins us, Global Head of G10 FX Research at Standard Chartered. The pound was really weak yesterday as a result of some of the policy making and announcements by the Bank of England. What does Stephen think of that? And speaking of the Bank of England, we will bring you more from our interview with the Governor, Andrew Bailey, as the BOE works to damp down inflation.
Well, the fact that we've done 75 today, nobody should read into it that's the new norm. I don't think people would be surprised when they see that we and the Fed are looking at things through slightly different lenses.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta with Kailey Leinz in New York and Anna Edwards in London. Matt Miller is off today. He's missing a really interesting chart because, of course, as the markets are slowly repricing, the inversion that we have all been watching, the 2s-10s curve, is inverting even further. Now, it's been in negative territory for several months now, but now we're hitting a new extreme going all the way back to the 1980s, negative 57 basis points on this particular spread. What's interesting, though, is that traditionally when you hit recessions, you kind of hit them to about negative 40, negative 50 basis points. You saw that in 08. You saw that in the dot-com bubble. You saw that even in 1997, briefly with the Asian financial crisis. You didn't necessarily see that going back in the 1980s when inflation was a massive issue. And then you saw deflation kind of follow. That margin was somewhere in negative 200 basis points. The question is that where we're headed as we hit further and further extremes? Who better to answer that question than Marcus Ashworth, Bloomberg opinion columnist, who joins us now from London, I believe. Marcus, thank you as always for joining. Let me pose that question to you. We've compared this era to the 70s, to the 80s, simply from the inflation metric. From an inversion metric, are we going to hit that negative 200?
I honestly have no idea, and I'm not sure anyone does. All I can see is that 2-year yields are at the highest basically for 15 years. Since the global financial crisis. I keep on thinking they can't go any higher. It obviously looks like they might try and touch 5, but I don't see there's much more upside for 2 years. I know the Fed sort of whipsawed the market there, particularly in that press conference, because everyone read in that cumulative tightening and the lags and got excited. And yet again, Powell had to pour cold water on everyone. Everyone's listened to that message, but I'm not sure how much longer that can carry on for. So I think we're probably about as close as to the top of this, or the lows in the case of the spread, as you can get. And I certainly hope 2-year yields won't get much higher because it's killing the rest of the world. I mean, honestly, what happens to wider out from the States because of these higher US Treasury yields is really very painful.
Yes, and let's think about that divergence a little bit, Marcus. The Bank of England making a brave stand for its own direction yesterday, saying that the market is expecting too much. But is that difficult for the market to take seriously the day after the Fed reiterates its hawkish path? Is it difficult for the BOE to diverge?
It's difficult, but I think they're going about it as well as they can. It's always incredibly confusing, the Bank of England. They put out a bunch of forecasts, which everyone gets very excited about, and then they realize they're meaningless. And these ones are particularly meaningless because they told us they are meaningless in the context that they are based on market rate forecasts, which they now have made explicitly clear they don't believe because that's not what they're looking at. However, we are going to get, inflation dropping, but not for quite some while, and we are going to get, and probably are in, a recession in the UK. Therefore, Bank of England is just, as Bailey just said on your piece there, that they're looking through a different lens. They're brave enough to say it. We can see the central banks of Australia, Norway, Canada are also basically starting to edge away from just following the Fed. The key one here is the ECB. They try to pretend that they are, like the Fed, sticking with the mantra of must fight inflation. But the economy is nowhere near as strong in Europe. Even the UK's is probably in better shape overall compared to the US. There are different worlds, and we have to try and diverge ahead of when the Fed finally itself will pivot, which I think will be early next year, if not possibly even before then.
Marcus, what kind of a problem does a potential reopening, a slow reopening of China cause for the Fed, the ECB, the BOE, in that maybe that does provide a growth boost, but it's also demand that can boost inflation?
I don't think it's really on their radar yet. We just don't know enough about when it's going to happen, if it's going to happen, the strength it's going to happen. That's going to be one of those problems we're going to have to take as it comes along, adding yet more complexity. I think front and center what goes on in Ukraine and with energy is more important. And clearly we're seeing feed-through effects now into housing in lots of markets around the world, including the US. They're much more front and center, and I think that's really, with the payrolls today and one more before the next Fed meeting and 2 more CPI numbers, that they can only deal with what they can see in front of their faces. As far as China's concerned, I don't think it's going to be that big a mover this year. Early next year, it could be substantial, but as I said, I don't think you've got any read on that.
Marcus, thanks so much for your time. Marcus Ashworth, Bloomberg Opinion columnist. Thank you for joining us to talk about many themes in the markets. You can find out more on all of those themes. Get market analysis on the Markets Live blog. MLIV Go is the function to use on your Bloomberg terminal. This is Bloomberg. This is Bloomberg Surveillance Early Edition. Here's what you need to know. Today's US jobs report could determine what the Fed does next. A tight labor market has been pushing up wages and inflation, prompting the Fed to raise interest rates further. It's the new era of tech austerity. Lyft is making deep job cuts. Amazon puts some hiring on hold, and Twitter prepares for massive layoffs today. And the stock frenzy in China goes into overdrive. Investors are spurred on by market-friendly headlines and the hopes that the worst just could be over. I'm Anna Edwards in London with Kailey Leinz and Chrissy Gupta in New York. Matt Miller is off today. And Chrissy, that news from China, or well, a lack of specific news at the margin, news about aviation and some audit news that all sounds pretty market-friendly, a little better mood music, I suppose. All of that adding up to a real surge in Asian markets, and that is having a big impact on Europe today.
Yeah, and the United States as well, a little bit of a risk sentiment spillover, if you will. But I also have to highlight, remember, we've had 4 days of losses in the S&P 500, so we are almost due for a little bit of technical bounce when you do look at what the S&P 500 futures are doing, specifically rising by about 0.7%. But take a look at the bond market, because yesterday, whereas the stock market was perhaps a little less volatile, the bond market was going bonkers. Today, this morning, not so much. About 412 on the U.S. 10-year yield, only down about 2 basis points. So you are seeing the bond market have a little bit of a bid across the curve. But once again, nothing crazy, a lot of perhaps wait and see ahead of the U.S. payrolls report. That, however, is not guiding the dollar. That's where you're seeing some very real weakness. The Bloomberg dollar index weaker by about 0.5%, which I think is in turn reflecting in the commodities market. NYMEX crude out of trading with a 90 handle, up about 2.7%. But once again, likely taking its cue from Asia as well, Kailey.
Well, on that note, obviously we saw massive moves for Chinese technology stocks in the Asian session, and a number of those have listings here in the U.S. as well. So those ADRs are outperforming. The auditing progress in particular is a good news for these companies that for a while they were worried they might get kicked off U.S. exchanges. So as a result, Alibaba, JD.com, each up in the ballpark of 8.5% to 9.5%. So big moves there. But of course, there's other earnings movers we have to pay attention to as well. A couple moving to the downside in a big way, including PayPal with missed expectations, less spending on its platform because consumers seem to be spending less on discretionary things when they're spending more on things, necessities like food and groceries and gas and all of that. So PayPal is down about 7%, and it's an even bigger plunge for Atlassian, the software company. Gave a revenue forecast that handily missed expectations. As a result, that stock getting punished, down 23% before the bell, Anna.
European equity markets then getting that boost, Kailey, we talked about from the Chinese story. So European stocks up by just over 1%. Basic resources playing a big part there. One of the best performing sectors all morning, up by 4.6%, as we see some of those commodities get a boost as a result of this better mood music coming through from China. That then plays well for UK stocks in particular, the London market doing well out of that. Sticking with the UK theme, the Bank of England pushing back against market pricing of rate hikes quite intensely. Yesterday we heard that from Governor Bailey, more from him later on in the programme, and we heard it from Hugh Pill speaking to media this morning. So there's been this concerted effort to try and bring those yields down. Markets, are they listening as much as the Bank of England wants them to just yet? Will this take some time to price in? We'll see where that one goes to. Kering, the luxury goods company, up by 3.5% their share price today. This as a result of some speculation that some M&A could be taking place here, Chrissy. Could they do a deal for Tom Ford? Could they buy Tom Ford? Markets actually suggesting this could be quite a positive. Analysts suggesting it could be a positive. Is the stock moving on that, or is it, though, the read across from the China story? That has typically been pretty strong, of course, for luxury companies, Chrissy.
You know, Anna, it's interesting that you mentioned the M&A story specifically, because sometimes those simple capital flows that you're seeing across Atlantic can also drive flows in the FX space. I'm sure Stephen Englander, Standard Chartered head of global G10 FX research and North American macro strategy, knows all about it. But Stephen, I want to start with a different story, and that, of course, is what's going on right here in the States. There seemed to be this idea that there could be a bear case for the dollar forming if the terminal rate for the Fed does indeed stall out, in turn boosting equities as well in its wake. Now that you perhaps aren't necessarily seeing that, or a little bit of delay in repricing, is the bear case for the dollar dead?
I don't think it's dead. And I think if you look at the BBDXY chart, what you've seen is that, every time the dollar gets close to 1350, it really begins to struggle and bounces down. There's a lot of very good news that's already priced in. The Fed is part of the story. And again, I think, the market was a little puzzled by Powell's hawkishness. He had only one CPI and one payrolls report between the September numbers and the press conference the other day. We'll have to see how the data play out. We expect things to slow down. I think what you're seeing is, with the inversion of the curves, the market is increasingly expecting the tightening to have the impact that's desired. And then you get to the rest of the world where, Japan is beginning to talk about the disadvantages of a weak yen and sort of tiny opening of the door to easing yield curve control. We have the positive news out of China. It's affecting all the commodity currencies in the commodity space. Europe has a ton of catch up that they have to do. So I think it obviously puts the imminent weak dollar story at risk, but there's something there where all the good news is already in the dollar. It would take a lot of good news, I think, for the dollar to really spurt further.
Which then brings us to today's data report. Of course, we have payrolls coming in about just under 3 hours. Stateside, what does that do to the dollar, Stephen? If we have a positive number or that beats expectations, is that good news for the dollar or bad news, and then vice versa?
Well, first of all, there are 3 numbers that come out, and each of them can affect the dollar. I think that if we say we get NFP over 250,000, I think the expectation is 200,000. If earnings come in well above the 0.3 that's expected, or if the unemployment rate unexpectedly drops, all of that could end up being dollar positive. That's not exactly the trend in the market. I mean, the indications, and they're very loosely correlated with payrolls, that the labor market is slowing. You see sort of weakening demand in the ISM surveys. Claims are low, but continuing claims are climbing, which suggests that the people who have lost jobs aren't finding them again. I think that there is risk there, and there's multiple sources of risk. On the whole, I'd say that the risks are to the downside in the sense that it comes out maybe more weakish relative to our forecast in the market baseline than strongish. But obviously there's a lot of probability on each side, so you have to be very careful going into the numbers.
Yes. Stephen, I wonder whether the Bank of England would like to see a rollover in US labour market data. And I say that just because they're trying to chart a different course, aren't they? I mean, they're not alone. A number of other central banks, Norway, Australia, Canada, trying to go in a different direction. But with the Fed committed to hiking and talking about higher terminal rates, that's proving difficult. Where does the pound go through that?
Well, I think it's a different kind of special relationship when the Bank of England is praying that the U.S. economy slows down. I think the whole world would benefit from a weaker dollar at this point. I think, again, the Fed's got its dilemma. Its mandate is domestic. It's not saving the world, but I think it recognizes that the strong dollar is exerting a negative impact on the rest of the world. And, if your objective function, if your goal was to maximize world benefit, you'd have a weaker dollar. But again, that Powell makes it clear he's focused on U.S. inflation.
Steve, finally, we're 4 days out from the midterm, so I have politics on the brain. What is the best and worst case scenario for markets, depending on the outcome and the implications for fiscal policy?
Again, the market hasn't really focused. There's been many more proximate drivers. I think if you end up with a Republican sweep, you have to wonder if some of the restrictions on sort of energy exploration and kind of might get eased, in which case, maybe lower energy prices. And again, it's a long step from here to there, so we have to see how things play out. But I think that that's one direction that a strongly Republican Congress could certainly try and push developments.
Okay, Stephen, thank you very much. Stephen England of Standard Chartered, thank you very much for joining us. We have Olaf Scholz, the German Chancellor, making his visit. A fine balance he's trying to strike between human rights concerns, geopolitical concerns and business interests. He's making a visit, of course, to China and taking a business delegation with him. Interesting to see that Airbus comes out of this pretty well. Airbus signing a $17 billion China jet deal during Scholz's visit. The Airbus share price getting a little bit of a boost from that. We had another red headline on the Bloomberg in connection with Scholz's visit, saying that China will make the BioNTech shot available to expats, so not perhaps to other parts of the Chinese population, but certainly to expats. That seems to be the news there. That is the Pfizer BioNTech vaccine for COVID. That could be significant. Now, coming up on the programme, the Bank of England lifts rates but pushes back on future increases, as we were just discussing. More from our interview with the Bank of England Governor Andrew Bailey. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Preeti Gupta with Kailey Leinz in New York and Anna Edwards in London. Matt Miller is off today. Let's take a look at what's going on ahead today. German Chancellor Olaf Scholz is in Beijing on his first official visit to meet Chinese President Xi Jinping. Boston Fed President Susan Collins is also speaking at a virtual event hosted by the Brookings Institution at 10 a.m. New York time. And we'll get the U.S. jobs report at 8:30 a.m. Eastern. Really all eyes on that, Kailey, as we really have the countdown to what could be a game changer for the Fed.
Absolutely. And of course, the Fed and inflation and the labor market, all economic issues that are feeding into voter sentiment ahead of the midterm elections, which are shaping up to be historic on Tuesday. Republicans needing to gain only 1 seat to take control of the Senate and only 5 for control of the House, one of the smallest margins for either party in decades. Mick Mulvaney, former acting chief of staff for President Donald Trump, spoke with us here on Early Edition yesterday on his outlook for Tuesday's vote.
January 6th was a dark time. There's no question about it. I've been a critic of January 6th for the last year at least. But for Biden to come out and use that as his closing argument, I think might give you some insight as to why a lot of folks are now saying it's going to be a red wave. The Democrats continue to avoid the conversations that swing voters, people who don't make up their mind into the last 30 days, which are the folks right now who are going to sort of determine the outcome of this election, want to talk about inflation and crime. The Democrats open to talking about abortion, and they're closing talking about election integrity. Abortion and election integrity are critical. There's no question they're important topics, but it's not what voters want to talk about right now.
Emily Wilkins, Bloomberg government reporter, is joining us now from Washington with more. Emily, the closer we get to Tuesday, the more it seems momentum is building for the Republicans. Why?
I mean, Kailey, you're absolutely correct. If you are a Democrat watching the polls, a lot of hope that you have is evaporating right now because we are seeing key races in Arizona, in New Hampshire, in Pennsylvania, in Georgia, all really tighten with those margins. And I think Mick Mulvaney really sort of hit the nail on the head there. A lot of it is because of the economy. I mean, Democrats have been trying to message, trying to blame big corporations, trying to point to things that they've done to lower costs, but it's just not sticking when compared to the fact that folks are paying way more than they did at the gas pump, at the grocery store. A lot of that blame is going to the Biden administration. And yes, you are seeing Democrats really scramble now, hitting the campaign trail. You've seen Vice President Kamala Harris out. You've seen Biden himself going to California as well as New Mexico. Interesting, those two states, being deep blue states, not the kind of swing states that you think about a president going to, but again, speaks to what Biden's popularity is at this time. You've even seen folks like Oprah come out for the Pennsylvania race. She said that she would have voted, had she lived in Pennsylvania, for John Fetterman, which is incredibly notable given the fact that Dr. Oz, Fetterman's Republican opponent, rose to prominence thanks to her.
Well, Emily, break it down for us via demographics here. Asian Americans, for example, playing a renewed role.
Yes, I mean, obviously Republicans and Democrats, they've been trying to talk to a number of different groups this election. We've talked, I think, a lot about the Hispanic vote, the Latino vote. Obviously, that's incredibly critical in a number of swing states. But the Asian American vote is also being really closely looked at by Democrats and Republicans at the national level and at the state level. I mean, some of these states, I was in Nevada, and the outreach that both candidates are doing to Asian American voters is really, really intense.
tense. And I've talked to folks who've said that they've tried to build the infrastructure to have there for 2024. Asian American voters, they've tended to lean Democratic in the past, but there are signs that more and more of them are open to supporting Republicans and the Republican Party. Republicans really do see an opening there, and they're doing everything they can to really make sure that they are messaging to that group, as well as Hispanics, as well as blacks, and of course, as well as voters as a whole.
What is Biden's last-minute message to the electorate, Emily?
Well, we saw the other day that he did really hone in on January 6th, and certainly that's something that's very important to the Democratic base. And part of the midterm challenge is getting your base out, especially if you're the party in power. If your folks think that everything is going just fine because they see a Democrat in the White House and Democrats in Congress, they might have more incentive to stay home on election day. So by talking about something like January 6th, by talking about election deniers up and down the ballot, Biden is really speaking to core Democrats, saying, hey, if you were thinking about staying home, you really, really do need to come out for this election.
All right, well, we'll look forward to the president's remarks from San Diego later today. Emily Wilkins of Bloomberg Government, thank you so much. And of course, don't miss our coverage of the U.S. midterm elections on Election Day. That's Tuesday at 8 p.m. Eastern. I'll be down in Philadelphia. Cree's going to be in Washington, D.C., along with David Weston and others. We'll have full coverage for you of that next week. But on this Friday, that's going to wrap it up for Early Edition. More surveillance is ahead. They'll be breaking down the jobs report with guests including Fed Governor Randy Kroszner, among others. This is Bloomberg.